With inflation soaring, many of us are struggling to pay our bills, and yet the medicine prescribed by central banks seems to be higher interest rates, even though they know this is likely to trigger a recession. Now, given that a recession makes a country poorer and it means less job security, how can it be a good thing? Now, don't forget, if you do enjoy our content, please do subscribe to our channel so you don't miss any new videos. So now let's look at why a recession might be a good thing in a bit more detail. Here's the biggest economic problem in the West at the moment, which is very high inflation. So for example, in the UK, the rate of inflation's topped 10%, but there are some forecasts it's going to reach above 18% in January of next year. And if we look at other countries such as Germany, the US, Italy, and France, they have similarly high rates of inflation. So it's the job of central banks to get that under control. To illustrate the problem, we can look at a specific example, which is airlines, where there's been a big supply-demand imbalance. So in this top panel, you can see the load factor, that's the percentage of seats in aeroplanes which are filled up. You can see that before the pandemic, that was typically rates of above 75%. However, during the pandemic, it fell dramatically. Then in the bottom panel here, you can see the year-on-year increase in US airfares, which is a subcomponent of the CPI rate of inflation. Notice how it absolutely soared, actually in two peaks, in 2021 and 2022. And in fact, if we go back further in time, you can see that the rate of increase is the highest it's ever been, at 38%, even though it has come off that peak recently. If we think about the reason for that, well, when demand fell, what happened was that the companies laid staff off. That made perfect sense because there was less demand for their service. What surprised people was the rate at which demand recovered, and it certainly left airlines short of staff, and also fuel prices spiked, which meant that prices to run the airline increased. Those two factors meant that the airlines couldn't ramp up their service quickly enough to meet demand, and consequently prices surged. Another example, which is slightly different, is automobiles. Now this top panel shows you the sales of automobiles and light trucks in the US in millions of units. And you can see that it tanked with the onset of the pandemic, and then it surged upwards again very rapidly. And in the bottom panel here, you can see the annual increase in the price of used cars and trucks in the US. Notice how that surged, and now it has fallen back, but it was because of slightly different reasons as airlines. Demand fell because of the pandemic, that's in common, and of course sales fell as a result, and then demand recovered due to all of that pent-up demand. However, the bottleneck in this case wasn't fuel prices and it wasn't a lack of labor. In this case, it was a shortage of chips, because most cars nowadays are just computers on wheels. And that's why people were buying second-hand cars, because the chips weren't available to deliver new cars. That demand couldn't be satisfied. And as a consequence, second-hand prices were the ones which surged. Now, these are just two examples. There are many others which are similar. There were either supply chain bottlenecks which drove up prices, or it was due to a shortage of labor. That was the case in many customer servicing industries. So what can central banks do to bring supply and demand back into balance? Well, central banks can't control the supply side. That's really the job of government. What they can do is reduce demand. And they do that primarily by raising interest rates and making their policy more restrictive. Now, there are various means by which this is transmitted into the economy. So now let's go through some of those monetary transmission channels to see how it affects the economy and reduces demand. The most obvious one is that if interest rates are higher, it costs more to borrow. So the cost of capital increases. So if you're buying a house, the cost of your mortgage will increase. If a company's borrowing in the bond market, its cost of borrowing will increase. So by increasing the cost of capital, you reduce the activity which creates the demand. Another effect is the wealth effect. Generally, wealth decreases as interest rates increase. For example, if you look at growth stocks in the US, they've tumbled. And one of the reasons for that is that their future cash flows are worth less when the risk-free rate increases. Although it hasn't happened yet, I suspect we'll also see house prices fall. Now, when people feel poorer, they're less likely to consume. So again, that's going to reduce demand. If interest rates are higher, it means that you can put money aside in savings or by buying a US Treasury, say, and that money will be worth more in future. So that might make you delay your consumption. And by delaying your consumption, you're reducing demand for goods and services. When interest rates are higher, generally it strengthens the currency, and that means when it buys goods and services which it imports, those become cheaper. So this is called pass-through inflation, which is reduced if your currency appreciates versus its trading partners. Now, if the cost of capital is higher, then lenders, in particular banks, are going to be more restrictive in their lending standards. So for example, if you look at US car loans, you can definitely see more restrictive lending if you look at the Senior Loan Officers Survey, for example. The same would be true of the criteria for being accepted for a mortgage, for example. So again, if you can't fund those purchases, it'll reduce demand for those goods. And then finally, if unemployment is higher, then people will be worried about losing their job and they'll be less likely to buy high-ticket items. And it also has an effect on wages, as we'll see in a moment. If you like our videos, you'll love our weekly market roundup. I publish it every Friday. I try to keep it short and punchy and focus on news which I think is important for investors. If you want to learn more about how to sign up for that, and it's completely free, you can learn about it by clicking on the link beside me and in the description beneath me. Now, you'll often hear central banks talking about a tight labour market as if it's a bad thing. What that means in practice is that unemployment is very low. For every person who's unemployed, it's a very high number. So for example, in the UK right now, we have a vacancy for every person who's unemployed. That doesn't mean people can just walk into a job because they might not meet the requirements of the job, so there could be structural mismatches between the jobs available and the people looking for work. But what this does show is that currently the UK labour market is very tight. Now, if that number falls, we describe it as a loose labour market, or a labour market in which there's lots of slack. If we look at the comparable number in the US, it's even more extreme. So this data goes back almost to 2000, and you can see that currently there are just under 2 jobs for every person who's looking for a job. The reason why a tight labour market worries central banks is that it can create something called a price-wage spiral. So for example, at the moment, we can see inflation's running very hot, which means that prices are increasing. If we combine that with low unemployment, which is also what we see across much of the West, then it could create a much stronger negotiating position for someone who's currently in employment. And that's because it's very hard for an employer to replace them. So when it comes to wage negotiations, they're in a very strong position. Now, if they do manage to negotiate a higher wage, and wages are going up very broadly, then companies can raise prices further. And then we can get this kind of entrenched spiral where prices chase wages and wages chase prices. And that way inflation can become entrenched and last much longer and make it much more difficult for the central bank to stop inflation running hot. So this is why increasing unemployment can actually break this spiral. And what a recession means in practice is higher rates of unemployment. So although it seems like tough medicine, this could solve this inflation problem, at least from the wage point of view. So let's look at the evidence for a wage price spiral right now. The blue line here shows earnings growth in the United States going back to 2015, and it's currently running at 5.2% year-on-year growth. You can see that that's pretty high compared to where it was before the pandemic, when it was running at closer to 2.5 or even 3, maybe 4%. So wage growth is running a little bit hot, but it's still well below the rate of inflation in the US, which is 8.5%. The Federal Reserve's actually said that the current rate of earnings growth is inconsistent with its 2% target, so we'll have to get that back under control. The situation's similar in the UK, where inflation is running at 8.8%, those are the July numbers, and if we look at wage growth, that's currently 5.1%, so still well below the rate of inflation. So in other words, in real terms, wages are falling, but what you can clearly see is that the rate of wage growth is well above where it was before the pandemic. So again, the Bank of England will probably have to get that under control, and yes, that probably means a higher unemployment rate and a recession. Now, some people, you could call them optimists, believe that we don't necessarily have to have a recession in order to get inflation under control, and this is called a soft landing. And one of those optimists is Jerome Powell, the US central bank chair. And what he said recently was that having a soft landing is what we're aiming for. Of course, that has to be our goal. And then he goes on to describe a potential path to that goal. And what he's saying is that the labour market has such a large amount of surplus demand, and we saw that there are 2 job openings for every person looking for work. You could see that demand going down in a way that didn't translate into a big increase in unemployment. So what he's saying is that we could see that number of job openings fall without eating into the employment rate. Now, history is not on Jerome Powell's side there. What I've shown in this top panel is the rate of increase in the bank's policy rate in the US. So where it's red, they're hiking rates, increasing them, and where it's blue, they're cutting them. And I've labeled these H when they're followed by a recession, that's the end of the hiking cycle, and where it says S, there is no recession. In the bottom panel, you can see the US unemployment rate, which of course increases when you have a recession. Those are the blue shaded bars. Now you can see immediately there are lots of H's where a hiking cycle ended in a recession. There's one here, one here, one here, but there are a few of these soft landings, such as this one in 1995, when the Fed went through a whole hiking cycle without triggering a recession. So maybe they can pull it off, but personally I think it's unlikely. But the key point is, with inflation as high as it is now, central banks are very much favouring reducing inflation over avoiding a recession. So for example, here's a statement from Andrew Bailey, the Bank of England governor, who's making the point that if they don't act, inflation's going to become more embedded for the reasons that we've seen. It'll get worse and we'll have to raise interest by more later on down the road. We have to act if we're going to stop that. And he also said that there are no ifs and buts about getting inflation back to that 2% target. In other words, the trade-off between a recession and inflation clearly comes down on the side of getting inflation under control. In conclusion then, it is looking increasingly likely that we'll get a US recession, and it's almost certain that we will in Europe as well. Despite the hopes of a soft landing, I think it's unlikely. I'd say it's more a question of how hard the landing's going to be, but also how long the recession could last. Now, as we've seen, a recession could be a good thing because that's what's necessary to get inflation under control. It'll reduce demand, it'll produce more slack in the labour market, and historically that's been very effective to reduce inflation. But of course it comes with its own economic pain in the form of job losses. So recession is disinflationary. It does reduce the rate of inflation. However, the problem in Europe, but also to a lesser extent in the US, is that some components of inflation, such as energy, are not under control of interest rates. It's more to do with geopolitical problems in the form of Russia's invasion of Ukraine. So even if central banks raise interest rates, there will be a stubborn component of inflation which simply can't go away, not until this dispute is resolved. So although the medicine is unpleasant, I think a recession could be a cure to the very high rates of inflation which we're seeing right now. We need more slack in the labour market, and we also need to see a reduction in demand. Now, don't forget, if you do enjoy our content, please do subscribe to our channel, and don't forget our offer if you want to sign up for our free weekly market roundup. There'll be a link to that beside me and in the description beneath me. And, as always, thank you for listening.